Hi. Uh, we've heard a lot today about what we should do, what we should invest in, and what is available in the market. There's been a huge movement since, I guess, the first time that Nippon filed for a gold ETF in India, which, by the way, was the first gold ETF ever filed anywhere in the world. And today, again, as Prem suggested, one of the important things that we need to talk about is how do you, which is all great, but how do you actually invest in ETFs? What are the nuances that you must know when you are looking at buying or selling ETFs? And one of the most important things to know, therefore, is what goes on at the back end, because that affects your price. And that for you as a trader, as a fund manager, as a asset allocator, or anybody else that is out there, it is one of the most important things. We do a bunch of these. Today, we are talking about one of the core ETF concepts. And that's ETF mechanics, and most importantly, liquidity. Right, so the ETFs have been around since the 1990s, topics and a bunch of those things that came about. So there's been a bit of an evolution that's happened in the ETF space globally and in India. Today, ETFs have far surpassed any other flows into any specific instruments in the world. Most important thing is they combine the structure of a mutual fund. So it's a fund, exchange traded fund, but it trades like a stock. Fairly basic. Most importantly, now again, you'll see two concepts out here. One is an INAV, which is an indicative NAV. And then you have the day-end NAV, which pretty much is not used for anything except marking your books. The INAV is something that allows you to price or figure out what the price is during the day when you trade. Like stocks, these are listed. They trade in real time. Unlike stocks, but like mutual funds, you can create and redeem these units on the go. Not you specifically, but there's an entity called an authorized participant that will do this. And in India, the nuance is that at 25 crores minimum ticket, you can go to the AMC and create fresh units or redeem them. Right? So what happens when an ETF is launched? Well, the first thing that happens is the AMC collects cash. The AMC may also collect stock. So you have authorized participant that can effectively contribute stock that goes to the AMC, and on the reverse leg, you get ETF units. Typically in an ETF, the NFO, as you call it, will have very low subscription because there really is no need for a heavy subscription. You do need some liquidity to begin with. So you'll have low subscription, but that's exactly what will happen there. The first day that starts to trade is where you can anyway continuously create or redeem units. So you will have a much bigger number coming in at that point in time. And then historically, this has been the case. So what are some of the myths that we have around liquidity? Everybody today will look at the number that is traded on a specific day or a specific point in time and say that is the liquidity. But that is not really the case. Even if you have a high traded volume for a specific ETF, but the underlying is not liquid, you will eventually have a price dislocation on that ETF. And so it is very important to understand that a liquid ETF is one where the underlying is liquid. Nifty, very liquid, right? The moment you go down to the small cap space, those you won't have that money, you won't have the underlying that is that liquid. So that's again something to keep in mind when you're looking at ETF liquidity. Right, so what are the true liquidity sources? First, market trading. So you've got regular investors who are buying and selling on the market. So there's price discovery, they provide liquidity. You have creation and redemption. Now, authorized participant is not a term that is frequently used in our business, but you will see it listed on every single AMC's website. Who is the authorized participant of the AP for a specific ETF? An authorized participant is the only person who is allowed, subject to the 25 crore minimum, to go create and redeem from the AMC directly. So these guys are the ones that effectively take advantage of the arbitrage, short terms that might exist in the market, and then create or redeem units to fulfill that demand or supply gap that exists in the market. Right? And then this is typically possible when you have price dislocations that are happening when there's high volatility and so on. Arbitrage, therefore, that exists is closed by these market participants. A market maker, on the other hand, is somebody who provides two-way quotes. So that's a little bit different from the authorized participant. In India, typically it's the same person who's doing both exercises, but globally, and again, in future in India, you might see a scenario where the market maker has a different job and authorized participant has a different job. Right? So what happens when you go to buy? So as an example, you go to give your orders to a broker. The broker has a large order. They can do one of the two things. If it's a large enough order, they can simply buy the stock from the market in the right proportion, or maybe not even in the right proportion, go to the AMC and get units in exchange. Or they can provide liquidity and exchange this the units on the exchange itself. Right? What all of these exercises do is they align the price of the underlying securities, which is typically stock or bonds or gold or silver, or any of those things, with the price that is trading in the market of the ETF itself. Right now, I'm going to come to a slightly complicated diagram. The genesis of this diagram is for the last, I guess, since 2010, I've been writing a note, which is a primer on how ETFs and index funds work. Anybody that's interested in that, I'll give my email address at the end of the presentation. Please write to me, and I'm happy to share it with you. Soon enough, you can also find it on our website. And that effectively, in one shot, tells you what an ETF liquidity is all about. Once we've gone through the mechanics a little bit, we'll get into what are the things that you must keep in mind when you're buying or selling ETFs. Here we go. All right. So what are the sources of liquidity? Now, there are some faint lines out here that are not visible. So all of these arrows that you see are effectively the sources of liquidity. So what are the people that actually provide liquidity in the market? The exchange traded, the fund itself, or the AMC that manages the fund. You have the authorized participants, what we've spoken about. These are the guys that create or redeem unit. So with the AMC, either for stock or for cash. You have the market makers. Now, the market makers are the ones that provide two-way quotes. So they will effectively fix what the price is going to be and buy unlimited quantities or sell unlimited quantities with a spread at those prices. And last but not the least is the exchange, which then effectively interacts with the investors. Right? So how does it work? The exchange-traded fund, authorized participant, can deliver cash or stock and get units. And vice versa, they can deliver units and get stock or cash. Right? That's your first lot. The authorized participant will supply the same thing to market makers. So once they've created or they've got some stock lying with them, they can either get security baskets for ETF units from market makers and supply them with ETF units or ETF units or securities basket, so they can exchange. See, remember, the default operating mode for any ETF creation and redemption is not cash, which you would typically see in the market. It is actually the securities. So you give securities, you get ETF units. You have ETF units, you give them, you get securities, right? The cash transaction where the AMC is selling, the underlying baskets or buying underlying baskets for you is an additional exercise, that additional service that the AMC provides, right? But globally, that is not the case, and typically you'd be charged money for it. In India, it's free. So I guess we have to thank the AMCs for that free service. The market makers obviously buy and sell ETF units, and they also buy and sell securities baskets, as the case may be, right? All of these things will determine your price. Now, if there is a problem in any of these processes, you will have an issue and you will have price dislocation. Great example is your foreign ETFs right now, because that limit is hit. A few months ago, that premium was upwards of 10, 15%. And today, that's a little bit of a discount. And that's because that first source of liquidity is today interrupted because of regulation. Right? So what is the premium discount arbitrage? Again, introducing a little bit of a term out here. When an ETF trades lower than its indicative NAV, that's called the ETF is at a discount. That literally means there's more supply, less demand. And the authorized participant will buy from the market, redeem with the AMC, make money on the arbitrage. The premium is the other way around. When you have less supply, more demand, the authorized participant can create and then sell in the market and therefore have an arbitrage there, right? This ensures that, so when you close out the arbitrage, obviously the ETF follows the NAV more closely, subject to creation cost, redemption cost, taxes, etc. Right. So what are some of the practical execution trips? This is all great in theory. The first thing is never ever use a market order. I'll give you an example. I used to run a mid-cap ETF, and there was a wealth management client, not ours, somebody else's, who wanted to sell. The ETF was a mid-cap ETF back in like 15 years ago. It's a little bit less liquid than what we would like it to be. So they called us. We said, okay, fine, give us a limit order. We'll talk to the authorized participant and market maker, and we'll provide liquidity. For whatever reason, they decided to place a market order. The price crashed by something like 8 or 9% instantly, which then led to the authorized participant figuring out there's obviously an 8 to 9% arbitrage because the underlying market hasn't really crashed. They then bought the units, supplied it to us, extinguished the units, got back cash, and therefore made money. So most important, never ever place a market order. Always use a limit order. You don't know what's the premium or the discount that is prevailing exactly at that point in time. And NAVs, remember, are snapshots. They're not like a continuously moving price. For large trades, you need to approach brokers, APs, or your fund manager. These guys will help you place the trade, right? However, we might like it to be a seamless, only on the exchange thing. When you have large orders, much like stock, they have the ability to move markets and cause impact costs. So that's the other thing. Focus on the underlying asset liquidity, not the ETF volume. And this is particularly true for smart betas, small caps, and other illiquid segments of the market, sectors specifically, right? Last but not the least, beware of mispricing. Always determine fair value, right? Some of the INAVs, for example, might be stale. I mean, you might have an ETF that is, the INAV is getting priced because of stale prices because the underlying market is closed. US, for example. So be aware and be careful about that one little thing. In conclusion, the liquidity in an ETF is derived from underlying stock, underlying securities, not necessarily from just the trading volume. Trading volume is basically a secondary thing. You must always know that the underlying is trading well for your ETF to trade well. Be informed investors. ETFs are powerful, flexible, efficient, but you must know what you're dealing with. Thank you. We have a minute and a half if there's a quick question. Yep.
Anubhav, we have so many ETF big law.
Yes.
Which all kinds about the like. Okay, we have things which go up to 750 stocks.
Yeah.
So how does that impact the liquidity of these things? And are these things really manageable?
Well, so that's where we have a peculiar problem in India. Globally, if you're creating let's say a 3,000 stock, like a Russell 3000 index, you don't really need to replicate the whole thing. You can just make sure that that's like almost perfectly correlated. The basket is perfectly correlated with the index, right? But in India, you will have a problem when you have very, very large baskets or very large number of stocks because you are supposed to hold everything. I mean, that's the law. So when you have a single stock that is like 0.001% of the index, that means the rest of the basket becomes reasonably difficult to manage. And therefore, that affects your liquidity, creation, redemption. But who knows, going forward, as AI comes in, as more maths, computing power, all of that comes in, that might not be such a big problem.
Are you saying that the Russell 500 index does not have all
3,000 does not have all stocks.
Okay.
Yeah.
You are selling the video for the wedding. Like all these better songs are coming in.
Yeah.
Then more of the former personality, hey, you're taking me the point where to what to build it before out the needs. Let's my start this in monitoring.
Well, thumb rule, you look at your average daily traded volumes. If the authorized participant needs to create or redeem units at any given point in time, then if they're not able to do that average daily traded volume, or if it's even close to it, you'll have a problem with ETF liquidity.
Well, how do you about that?
I think these are available on the exchange websites and all. Of the underlying, then you have to aggregate all. Yeah.
And
Sure.
yeah, this was dying. I thought it's in the rice use what just I'm
Sorry, I'm not able to hear you.
Yeah, well,
they play a line. The for the stock thing.
Yeah.
That is how they take you on the people that the device what is the one thing or you can
Well, you have to understand why is there a discount, right? There might be a future expectation that that specific index or market is going to go down, right? Which is generally the case where more people are selling and less people are buying. So you have a discount to the underlying, right? Because there's certain fear, there's a war.
I think that's like this thing.
Yeah. I mean, Mr. Trump decides that one fine day that something dangerous is going to happen, then everybody starts to sell US securities, then you might have a temporary discount. So that's why you need to be a little bit wary of why that discount exists.
well, I'm really sorry that we are out of time, but I'm sure our speaker would be available offline to take questions.
Yes,
sir?
absolutely.
But thank you so much for a wonderful presentation.